Let's get in our big market voice today, and that is Mihir Vora of Max Life Insurance. Thank you so much for joining us, Mr. Vora. I just want to start off by asking you how you read the new statements that have come in from the Bank of Japan.
One thing is clear that incremental steps will not be effective. They have not proven to be effective over the last 6 to 8 months. So if at all there is an impact to be made on the global markets and the Japanese markets, it has to be something which is probably a bit different and probably much bigger in scale than what we have seen earlier. The markets have easily digested the earlier smaller steps, and that's not given the desired results of higher inflation and a weaker yen, which the Japanese government desires. So probably we need something really big. We need to go through the fine print to see whether there is anything really significant in this or significantly different from what we've already seen in the last 12 months. And the second thing is that it's also a question of whether the political the system out there enables the fiscal stimulus also to be expanded, so to say. Because I think as far as Japan and most of the central banks globally are concerned, the central banks have done their job. The kind of rate cutting and quantitative easing that we've seen all over the world, it has been huge and massive, and probably we are now beginning to see that instrument getting a bit blunt and bit worn out, so to say. And it's now for the politicians globally to see whether they have the will to go the fiscal way to stimulate growth as well as to get back inflation in the developed countries.
Would you say that the picture is exactly the opposite in India? Would you say that in India we have to continue fiscal tightening and easing rates, or do you think that it's something that should happen in India as well? That even if you ease rates, give a monetary stimulus, fiscal, the fiscal bag has to be opened up a little bit more?
No, not really. I think whatever growth we are already seeing in India is because of government spending, and we do need a stable currency. We do need the Indian financials to remain credible in the eyes of the global investing community and the rating agencies. We have shown a pathway to the world that we are going to contain our fiscal deficit at certain levels over a period of time, and so far we have been following that path. And I think any deviation from that path would lessen our credibility. And credibility is very important when you want to attract foreign flows in equities, private equity, as well as fixed income. So I think we are doing the right things, and there is no need to change from what we are already doing in terms of the fiscal prudence as well as gradual easing of interest rates.
All right, let me go from the macro to the Indian markets proper, Mr. Vora. You are obviously overseeing various people who invest in the markets, partly in the markets, because I was looking at the various portfolios there, and depending on the kind of portfolio anyone has chosen, the kind of scheme anyone has chosen, there is some equity, some debt, some money market operations that you do. Now, all the funds that you get tend to be long-term, right? Because you're an insurance company. What difference does it make in terms of an investing profile if you were a mutual fund or an insurance fund?
So we have a couple of different kind of mandates. The ULIPs are very close to investment vehicles. They are very similar to mutual funds. There is daily annual calculations. The product profile is as varied as what mutual funds offer, starting from the most conservative fixed income fund to the 100% equity fund. So that's pretty much in line with what an investor wants from his investment portfolio. And then we have the traditional funds where they are run like a very tight asset liability matched portfolio. So our liabilities are very long term, 20, 30, 40-year liabilities, and we match our assets to make sure that those liabilities are taken care of. So it's a very tightly run portfolio with long term yield expectations. So the mandates in these two kind of funds are quite different.
So I was trying to look at some of the funds that are available on the website, and I was looking at the high growth, then you have a growth, then you have one which is called balanced, and the bias appears to be broadly in terms of consumer, financials, and within consumer there appears to be FMCG. There's a lot of auto that I could find. I could find some interesting names there, and obviously this is all July, so things might have changed a little bit as we've moved into September. I could also find some interesting names where you are actually looking at a supplier to renewable energy, an EPC company which actually works in the renewable energy space, but not renewable energy proper. So you have Power Grid, which is a distribution company, but not other power generators. You have, so that seems to be the kind of profile. Could you give us the logic behind that? Why do your funds have that kind of a profile?
Sure. So the broad investment thesis that we are carrying right now is that Indian economy is going to be pushed by local factors. So the basic thesis is that Indian growth will come by domestic sectors, not from international sectors. So broadly speaking, sectors like IT, pharma, etc., which are linked significant to the global economy and exports, are sectors in which we are underweight. And we are betting that the domestic growth will outperform, external sector growth. So essentially, when you talk about domestic growth, it boils down to sectors like consumer discretionary, industrials and infrastructure. You're talking about financials, and within financial, of course, you would notice that we have much more overweight on the private sector rather than the public sector. So what we are saying is that given the fact that we have seen the government doing a lot on the ground in terms of policy reforms, structural changes, etc., and the fact that government capital expenditure spending has been robust and should be followed up by more of the same in terms of NHI projects, more roads, airports, etc. So we do believe that the infra cycles should continue. Private sector financials should continue to take market share away from the public sector financials. So we should see much higher growth there versus the GDP and versus the PSU sector. And thirdly, because of a good monsoon, the pay commission impact and the OROP impact, the urban and rural consumption theme should continue to get a leg up. That's why we are bullish on the sectors like autos, which includes cars, two-wheelers, etc. So essentially, we are basically playing a slow domestic recovery with the consumer continuing to remain strong, but gradually the infra and capex cycle also coming up in the next few quarters.
Okay, when I compare the high growth fund and the growth fund, then I see big cap is much more present in the growth space. And there, although you are saying that you're underweight on IT, I did find 2-3 big IT names right at the top in terms of the weight. But again, that's July.
Sure.
When you're talking about growth, which is long term, and something that you're talking about, which is slightly probably higher risk, which is high growth, then the portfolio composition seems to be changing in terms of the size, market cap of the companies. Is that a fair assessment?
Definitely. That's exactly the way the funds are positioned. The high growth fund does look at smaller stocks in each of the sectors that we talked about. So while the sector view remains the same, the choice of stocks is different across funds depending on the portfolio positioning and objective.
So is that a choice that your investor makes? If I buy a ULIP, do I make a choice that I want to go into high growth or growth, or does the money that comes in is...
Yes. No, that's the choice that the investor makes. It's completely his choice.
What about the traditional insurance that comes in, which is not ULIP related, but where you get the money flow coming into a corpus, where there are redemptions, where you have to pay out when someone dies, or there is a, let's say, some kind of a medical insurance claim, but otherwise you have a more or less steady kind of fund that you invest. What is the space that you're looking at when it comes to that?
Sure. So in the traditional funds, the corpus is even more stable, and given the fact that our persistency ratios are amongst the highest in the industry, our renewal premium is also a large amount. So we basically get income from fresh business that we sell every year, renewal premium that comes from the business sold in the previous years, and the income generated on the portfolio. So we have a steady accrual to the portfolio every year, which is very predictable. And there are hardly any negative outflows in this fund. Probably never any negative outflows, because the income on the portfolio plus the renewals and the fresh business are quite large amounts. So essentially, you're right. We do get the luxury of investing with a very long-term perspective. But broadly speaking, we break up the portfolio into the equity portion, which is a smaller portion, and the fixed income portion, which is a much larger portion. And the fixed income portion basically takes care of almost all our liabilities, way into the future, 10, 20, 30, 40-year liabilities. And the equity, and of course, it gives us the regular income to pay out normal cash flows and claims, etc. And the equity portion is what gives us the long-term returns kicker. So that's how we pretty much run the portfolios.
In terms of the breakup of the bonds that you buy, and you give a detail in your portfolio analysis, and of course that's of the, I guess, the ULIPs. Has the number of corporate bonds increased? The weightage of corporate bonds increased over time, or has it reduced?
So in the ULIPs, what we have been running in the last 2 to 3 years is more of a duration strategy. Our view has been that interest rates in India structurally are coming down. So we have been maintaining a portfolio duration which is significantly higher than the benchmark duration. The call has turned out right. Interest rates are coming down, have come down, and are likely to go down further in the next year or two. So we will continue to run a duration portfolio, because when the 10-year bond yield moves down by about 20-25 basis points, the yield pickup or the price appreciation that you get in the bond is far more than the 50 basis points or 60 basis points uptick in yields that you get in a corporate bond. So till the time that we expect yields to keep going down, we will continue to run a high duration strategy rather than trying to take credit risk. But what will happen is 2 years down the line, rates will stabilize. There will not be a room to go down any further. That's when we will shift the duration to a lower duration, and then we will start looking at more corporate bonds to give us the yield kicker. At this point in time, we continue to run a portfolio which is more skewed in favor of government bonds.
I was looking at again on your website the kind of range that you have for equities, for money market and the debt that you've broken out. In some cases, and this is again July, so correct me if you're wrong, and in fact I would like to know if you can make public as to which way the thing has moved. If the range is, let's say, 0 to 40% in equities or 0 to 70% in equities in some cases, you are somewhere in the midpoint when it was in terms of exposure to equities. But has that increased, or do you think that valuations have gone up too much right now and therefore you need to start taking off equities right now?
Right. So tactically, we are saying that the market has run up quite sharply, and the earnings momentum has not kept up with the market rise in the last few months. If you look at the last quarter numbers, also the overall market earnings growth has been pretty much in the single digits or thereabouts. So the market does look a bit frothy at this point in time, and we do believe that the market should take a breather. And there should be a time correction, if not a price correction, a little bit of that here and there. And in the next 1 quarter, again, we should start the market to digest the fresh earnings and start moving up again. So you're right, especially some of the mid caps and overall market also is trading at valuations which are about, probably I would say about half to 1 standard deviation above the long-term averages. So it is time for the markets to take some kind of a breather.
That breather you mentioned could be a time correction, which means that it could probably just consolidate at this level, which, if you take into account inflation
Correct.
and things like that, effectively means that it's correcting, right?
Absolutely.
All right. Would you right now be rebalancing at this moment, moving more towards non-equity kind of funds, investments, given that the markets have run up?
Yes. So as I said, we are holding some amount of cash in the portfolios, probably a little higher than what we usually do. So it's not a very bearish call on the market.
Is that normal? 6% even in July, was that normal, or has the level gone up right now?
So 4% to 6% is normal. We are at this point in time holding a little more than that. Of course, it's not 10%. So between 6 and 10%, a little higher than normal. So as I said, it's not a very bearish call in the market, but we are probably keeping some ammunition ready in case there's some bit of volatility in the market, and you do find opportunities from time to time. So we're just keeping some dry powder for that.
Because our viewers more interested in equities, and I just want to pick your brains on that. I know you can't talk about stocks specifically, But let me take individual sectors. Let me start with cement. I know you were saying that the mid-cap space has gone up, but if one looks at cement, it appears that value can be found in the mid-cap space rather than the big-cap space. Would you agree?
Yes, definitely. But that's been the case for probably forever. The mid-cap cements stocks have always looked cheaper than the large-cap stocks, and some of them have, of course, outperformed. But sometimes, it becomes difficult to get in and out of these really small-cap funds or mid-cap funds. So our calls basically have been on the large-cap cement ones.
But I do see some larger mid-cap names out there, which is, I saw Ramco on a couple of funds, probably. I don't know if that has changed. But there is a heavy bias towards big cap overall. But let me stick to cement. Cement consolidation taking place, and we've been talking about this for some time. Capacity utilization moving up, operating leverage going up. Capacity expansion looks unlikely right now. But do you believe that the government will allow cement companies to have pricing power as they move higher and higher to up the capacity utilization scale?
So if you notice, prices have moved up, but they've not moved up so dramatically as to attract political attention or consumer attention. So I think it's been more of an orderly move. It doesn't look like usurious kind of a move or a sharp move which attracts attention of the media, etc. So I think probably it's more or less moving in tandem with inflation and a little bit of supply demand dynamics. I think the sector has demonstrated very, very impressive pricing power even in the downturn by making sure that capacity utilization is adjusted to take in account the price, the lack of demand, so to say. And I don't know how they do it, but it's happened. So prices have remained stable even in bad times. One of the reasons why you do see some of the larger cement stocks continuing to trade at a premium and continuing to do well is because of the inorganic opportunities available in the sector. So some of the excesses of the 2006 to 8 era, where groups which did not really belong to the cement business went into cement plants, etc., are now under debt and trying to hive off assets, and the existing pure play cement large cap companies have the ammunition to grow by taking over these facilities and plants, and we have seen a few deals happening already. So the market is not only paying a premium for the stability and visibility of earnings because of the stable cement prices, but also the exciting opportunity for the existing companies to grow inorganically, and there's a very large amount of capacity available out there for inorganic acquisitions. So I think that buzz will continue for the large cap cements for a while.
But I'm just going to try and understand it because, as a lay person, I just want to, again, pick your brains. That if I look at the way in which, cement, as you mentioned, that when there was a downturn, cement companies managed to keep prices stable. Now, you can keep prices stable because you're not increasing them. But as you reach capacity utilization, because a lot of the acquisitions that are going to take place, the consolidation that are going to take place, they were all producing cement. It's not as if they were idle or they could not produce. Now, as you go closer and closer to that space, and a part of your supplies are going to the government of India, which is building roads, which would probably have to spend in infrastructure, the government of India's radars are going to go up, right? That, okay, you now have pricing power because you don't have capacities left, but I'm going to crack down on you and not let you increase. So then your volume growth is kind of restricted and your pricing power is also restricted. And that's what I wanted to know. Do you think that that's a cause for concern?
See, as I said, the current utilization levels are not so high, and to reach a utilization level of 80 to 90%, I think we are at least a couple of years away.
Okay.
So the scenario in which the industry has so much pricing power as to attract attention is probably 2 years away, not at this point in time.
All right. Okay. I was talking about roads, and I saw that there are some, smaller companies out there, and it's interesting that you picked up some companies which are not on a lot of mutual fund radar, which are essentially into EPC and into road building. Now, are you also looking at companies which supply? Now, not just cement, but maybe cranes, maybe things which are used for building roads. Because we're not seeing major infrastructure, capital-intensive infrastructure coming up right now. It's essentially these which are slightly asset-light. Are you looking at such companies as well?
Yes, they are on our radar, though we haven't really bought into any of those. So it would involve a gamut of companies, as you mentioned, equipment suppliers, equipment financiers, second-hand truck financiers, etc. So those are all in the ambit of overall growth in the infra segment. But we got to pick and choose. I think it's not a V-shaped recovery we are looking at. So there'll be the first level, then the second level, and third level. So these plays probably will come in the second level place.
So it appears to me that when you say that it's not a V-shaped recovery, and therefore you're going to play first level. First level, as you mentioned, probably the first of the first levels is financials, right? Because that would be the starting point, and that's what you're playing with private sector. And I see NBFCs, MFIs there as well. What about first level suppliers of things like ball bearings, abrasives, things which actually are first level capital cycle suppliers? I don't see those on the list in the portfolios themselves. But is that something interesting for you?
Yes, these are interesting plays. However, again, most of these fall in the small and mid cap, not so liquid segment. So it probably requires a little more effort to buy and sell these stocks. So we, as of now, we are still sticking to the larger auto ancillaries, I would say, and of course the mainstream two-wheelers and car suppliers, and of course we are also positive on the truck cycle.
Is that because the size of your the amount that you manage is too huge? If you had lesser amount to manage, you would be able to. Do you have some limits that you have that not more than this much will go into one particular company, or not less than this much? And if you actually put in a certain amount, you'll end up buying the company. Is that a problem that you face?
Not yet. We have about 10,000 crores in the equity corpus, and about 28,000 crores on the fixed income corpus. So 10,000 crores equity is not a small size, but it's not so big that we can't buy into mid caps. But overall, if you were to kind of just analyze, the markets in the last 18 months have been quite volatile, and while mid cap overall have done well, it's been followed with huge bouts of volatility. So as of now, till we see a continuous trend in the market, we are still tending to be a little more on the liquid side of the stocks.
I'll take your permission and name a few stocks. I'm not asking you about them, but they're in the public domain. These were in the portfolios in July that we've been talking about, quite a few. And there's Ujjivan Financial among the smaller NBFCs. Then there is PNC Infratech amongst the EPC contractor players. There's Ahluwalia Contract that is there. Narayana Rudale in the healthcare segment. Then these are they are there in the max high growth space. But interestingly, Mihir Vora, and this is something that I started off with, and I just want to go back again. You seem to be, or at least your house seems to be betting much more on big cap established names.
Yes, though some of the names that you mentioned have already become quite liquid, so we have them in the bigger funds also. But broadly speaking, microfinance is a segment which really excites us. We see secular growth there at least for the next few years, and not only the names that you mentioned, but we also have other names in that segment, which are probably a bit larger also in the other funds. So that's a space that overall we are quite excited about. Lots of more penetration to happen in that space. And the other construction names that you mentioned, of course, are in line with our thesis that a lot of the growth currently, and at least for the next few quarters, is being driven by government spending, both on roads, etc., and urban infra. So some of the plays that you mentioned are reflecting that call.
I'll again, I'm sounding like a broken record, but I just want to get your sense, because I have been reading your interviews over the past few years, and I've seen that not off late, almost I would say a year you've been negative on IT, or at least have been underweight on IT. But when I look at even something like Max High Growth Fund, I see Infosys as number 2. I find, HCL Technologies out there, and I see essentially big cap. I see HDFC, I see ITC, Tata Motors, IndusInd, Yes Bank, TCS is out there, HPCL. And in the top 10, there's only one which can qualify as mid-cap or something like that, is Page Industries. And then in the top 15, then I get a Ujjivan Financial and a Techno Electric Engineering, which, as I mentioned, is a EPC which works in the renewable energy space. So out of the 15, there are 3 which are mid-cap. And as of July, as I mentioned, this is all about July, they together are 55%. The top 15 are 55% of your investment, the equity investment in high growth, which is probably the highest equity investment. To me, it appears that this house is betting much more on known names, stable earnings, rather than bet on high growth and future earnings.
Yes, as I mentioned, we do have a preference for liquid names at this point in time. But it's also a little bit of a function of the index. Most of our funds are benchmarked to the Nifty.
Okay.
And some of the, so Nifty itself means that we are probably looking at, IT sector, which has a weight of 13%. So you can't ignore some of the names in the portfolio. So specifically about IT, while we are underweight on the sector, we can't be zero in the sector because we are not running an absolute return fund. We are running a relative return fund, which still needs to be cognizant of the benchmark.
Right. Okay. The IT, I've been reading your views on it. Do you think that it's been a complete change in game, and now we should only buy IT companies if they come to about 10 times earnings, because then they're probably at a PEG of 1 times what the growth they can give over the next 5-6 years?
Yep. Yes, I would say probably not 10, maybe 12. 12 may be a good number because we need to give them credit for the really good ROEs and ROCs cash ROEs, ROCs that they generate. So probably maybe more like 12 to 13 times is something that definitely we should give for the quality of business that they run. But structurally, the segment looks like a 10% growth, industry growth, and the good companies in that maybe growing at 12 to 13%. So it doesn't, evoke that kind of excitement as it used to, say, 5 or 10 years back.
So, but it could become one of the growth utilities, right? It's something that it gives you a better return than a basic utility, but a kind of a growth utility, a safe bet. But would you say that because of the institutional interest, as you said, that because you're benchmarked to the Nifty, you have to have some, exposure. Even in the high growth fund, you mentioned 13% of Nifty is IT, and I can see 12% in your case is IT, just 1% below, even when you're underweight compared to the index itself. So just the fact that institutions have to be benchmarked, that IT will always have a base in terms of a support.
Yes, though what happens over a period of time is that if a sector grows less than the overall market, over a period of time, the benchmark weight of the sector itself will keep going down. So you probably may see IT, at not 13 but 7% weight 5 years down the line. And if you remember, IT used to be 35% of the market in the early 2000s, and it's already 1/3 of that now. So these things keep changing.
Mihir Vora, if you didn't have to kind of invest other people's money, what would you be doing in this market? If you were investing for yourself?
So the good thing about India is that we have, a growth rate which is at the worst probably a little around 7%, and in the best case at 8%. So at 7 to 8% growth on a secular basis, and in an economy which is still so underdeveloped, the exciting part is that there are always new segments and sectors opening up. 3 years back, nobody was talking about logistics. Now, with the opening of the GST or introduction of the GST, which now looks like a certainty at least 6 to 12 months down the line, there will be so many players probably in the logistics segment. There was nothing called healthcare or pathological lab chains in the listed space, but now we see that some of these companies are growing so well, and healthcare, especially hospitals and the diagnostics labs again have become a segment. probably multiplexes weren't so exciting, say 7 years back, but now you have a host of multiplexes listed. So in a developing economy, there will always be new segments coming up and entering into high growth phases as the per capita incomes and the urbanization improves. So there is always something new to find. There's always money to be made, even if the markets are not going anywhere. There are always stocks to be found. So that's what I would do. I would continue to look at stocks and segments which offer potential for the next 3 to 5 years and hold on to them.
All right, since you mentioned those, I might as well again, I know you can't talk, but we have some of the public mentioned. There's Thyrocare Technologies, in which there is some amount of investment that has been done, as Mr. Vora was mentioning about the labs. There's Narayana Rudale, I mentioned that as well. VRL Logistics has some amount of investment from Max Life's, I think the high growth fund, no, the Max Growth Fund is out there in VRL Logistics Limited. Mihir Vora, and this is a thing that I've been asking for the last 2 weeks to all big market investors and people with a lot of experience. Has the thrust moved from looking at high growth to looking at the past? As you mentioned, ROCs, ROEs, has that balance sheet instead of P&L? You have to show me the money that you've done it rather than give me an Excel sheet which shows growth. Has that movement taken place?
So that's always been one of our key considerations while investing. So while broadly speaking, we would say our style is growth at a reasonable price, but that has to pass the test of quality of management, free cash flow generation capacity, etc. So ROE, ROC is of course a part of that exercise. So it's never a standalone function of only growth or only valuations. We have to look at the qualitative aspects and the quality of balance sheet and the cash flows, etc. So it's really a mix and match of all these parameters.
But is there a sense that the world is changing and therefore stick with what you know? And the reason I'm saying that is that the huge technological changes that are taking place, and because of artificial intelligence, because of all the new things that are coming, and they're affecting everything, whether it's banks, whether it's cars, whether it's power generation, medicine, anything. So is there a sense that we are at the cusp of a major change and therefore stick with what you know?
No, in fact, I would argue the other way around. What you know is probably not the best thing in your portfolio. So you have to be on the lookout for new trends. And for example, in telecom, now nobody talks about voice, it's all about data. Right. So even in the established sector, things are changing so dramatically that you have to be on your toes and you can't ignore new trends. So I think investment is always about keeping track of new developments, new flows, new technologies, etc. And one can't just go to sleep on the portfolio.
Okay, one final question, and I was not going to ask this. I was going to let you go. I know I took a lot of your time, but you mentioned telecom, and I can't let you go without getting your view on telecom. Is it a sector where you're going to just sit back and watch, let the bloodbath take place, let the winners stand up and then invest?
Yes, that's pretty much our approach. You summed it up rightly.
All right, Mihir Vora, thank you so much for joining us. Pleasure talking to you. Thanks a lot.